Every so often, a number pops up in the financial world that looks impressive but feels abstract. China's foreign exchange reserves are one of those numbers. Trillions of dollars, updated once a month, usually tucked away on an economic data page that most people never visit. But behind that number is a story that matters far more to the U.S. and to American consumers than it gets credit for. China's reserves have been climbing again, sitting around the highest levels seen in years. On the surface, it looks like a technical detail. In reality, it's a quiet signal about how money, confidence, and power are moving around the global system. At their core, these reserves are China's financial cushion. They're what allow Beijing to stabilize its currency, manage trade flows, and protect itself during global shocks. When reserves grow, it usually means China is still exporting heavily, still bringing in foreign currency, and still has room to maneuver financially. That alone tells you something important about the global economy. Despite all the talk of slowdowns, supply chain shifts, and geopolitical tension, money is still flowing through China in a big way. But the part that really matters to the U.S. is where a lot of that money sits. A significant share of China's reserves is held in U.S. dollar-based assets, including treasury bonds. In simple terms, China helps finance the U.S. government. That relationship doesn't get renegotiated in headlines, but even small shifts can have consequences. If China holds steady or increases its exposure, it helps keep U.S. borrowing costs lower. If it slowly pulls back or diversifies elsewhere, yields can rise, and that feeds directly into mortgage rates, auto loans, and credit card interest for Americans. That's where this stops being theoretical. When borrowing costs creep up, consumers feel it fast. Monthly payments get heavier. Financing becomes harder. Spending slows. None of that requires a crisis. It can happen quietly, over time, just from shifts in global capital behavior. There's also a psychological layer that's easy to miss. Foreign exchange reserves are a kind of confidence gauge. When China's reserves grow, it suggests stability, that trade is holding up, that capital isn't fleeing, that policymakers feel comfortable enough to let money accumulate rather than burn through it defending the currency. That sense of stability matters to global investors, including those in the U.S. whose retirement funds and portfolios are tied to international markets. At the same time, China has been slowly adjusting how it thinks about reserves, diversifying away from complete reliance on the dollar, adding other currencies and assets. This isn't about replacing the dollar overnight. It's about optionality. And even that gradual shift sends a message: the global financial system is evolving, and the U.S. doesn't operate in isolation anymore, even if it sometimes feels that way domestically. For American consumers, this all filters down in subtle ways. Currency movements influence import prices. Interest rates shape buying decisions. Global confidence affects markets, jobs, and investment. You don't need to follow reserve data to feel its impact. You just notice when things cost more, when loans feel tighter, or when markets suddenly seem jumpier than expected. China's foreign exchange reserves may look like a distant, technical metric, but they sit at the crossroads of trade, finance, and psychology. They reflect how the world's second-largest economy sees risk, and how comfortable it feels holding onto U.S. dollars in an uncertain world. And in a global system this interconnected, that quiet confidence, or lack of it, has a way of reaching American households whether they're paying attention or not.